Hello, and thank you for joining us on this week's episode of HECMWorld Weekly's video podcast. Our first story is one that I want to share with you because I'm going to flip the script on this one, and I think you'll find value in that. And it comes from CBS News. It's 3 reverse mortgage red flags that homeowners should be watching for. Why in the month of August, I'm not sure, but we'll dive into it. And it says that many retirees are struggling to make ends meet, so they consider tapping into their home with a reverse mortgage, which we are well aware of. But they can give you access to cash, but they can also carry risk. I think it all comes down to the lender that you're working with. Now, last week I shared with you the story of Paul Ambrosio, who is not only a reverse mortgage borrower, but also a loan originator with C2 Financial based out of San Diego. As CBS outlines how the reverse mortgage works, I believe it's more important who a homeowner decides to do business with. Are they an ethical lender? What type of margin are you getting? How is the loan structured? And has this company sent deceptive or misleading advertisements that got the homeowner interested in the first place? Last week, I shared with you the story of Paul Ambrosio. He's not only a C2 loan officer out of San Diego, C2 Financial, he is also a reverse mortgage borrower and took the loan in 2023, and now he is inundated with deceptive and misleading reverse mortgage direct mail pieces. But what are the red flags that your potential reverse mortgage borrowers should be looking for? And so you can use this particular column from CBS as kind of a template. And when you're speaking with them, if they're not ready to proceed and you're going to be meeting with them later, you want to warn them about these 3 red flags. First are high pressure sales tactics, and that is one of the biggest red flags, says CBS, of any reverse mortgage discussion. So you can warn your potential borrowers, listen, you're going to get approached by other companies. If anyone's trying to pressure you to make a decision or to rush you, you want to turn around and go the other direction. I'm never going to do that to you. CBS News points out that legitimate reverse mortgage professionals understand that it's a big financial decision that the homeowner is making, and they need to take their time. They need to have time to discuss the matter with their financial advisor, their family, or anyone else they really want to confer with. CBS also notes that you want to be aware of any company that approaches a homeowner and says this rate won't be available next week, or you need to decide today to lock in the terms. And that is some of what we saw on that particular episode about deceptive reverse mortgage ads. Another pressure sales tactic is just nonstop contact, whether it's phone calls or emails. You want to space those out. And it says anyone that is in contact too much or shows up at your home, even worse, unannounced, you don't want to do business with. The second red flag that you want to warn your potential reverse mortgage borrowers about, because they're going to be contacted by others, are hidden fees or closing costs, and I would add terms that look just a little too good to be true. So those fees should be very transparent, broken down, and also explained clearly to the homeowner so they feel like they have a good understanding of what this particular loan is going to cost up front. Another red flag is if someone is being very vague about the fees, but also if they're reluctant to send you an actual illustration or quote. That tells you they have something to hide. CBS News also notes that those that are considering a reverse mortgage should pay special attention to the TALC, or the total annual loan cost, which factors in all those fees. If someone is being accurate, then you can really compare apples with apples, and they should be able to explain that rate. The third red flag to watch for, I think, is highly unlikely because borrowers are required to get HECM counseling before they can complete a reverse mortgage. So one thing you can tell your potential reverse mortgage borrowers that just aren't quite ready to move forward yet, but will be contacted by your competitors, is to warn them that anyone that tries to steer them to a particular counseling agency is likely not a very reputable lender. Another red flag within HECM or HUD counseling is if the loan officer or the lender tries to steer that homeowner to a particular agency or coach them on what they should or shouldn't be saying during that HUD counseling session. So to wrap it up, this CBS News column is very consumer-centric. It's geared toward the homeowner, but you as a reverse mortgage professional can take these 3 points and be sure to mention them to potential borrowers, because you're going to set yourself apart as an ethical and honest loan originator, and they're going to want to reciprocate and do business with someone who is helping protect them. Real estate is a very localized affair. Many of the markets that you're originating in right now are most likely not going to see any substantial decline in home values. Each market is unique unto itself with its own economic forces and factors in addition to supply and demand. But some markets will see a significant decline, and the trick is knowing what to look for. So this is why I'm sharing with you a recent column from Newsweek, and it points out one sign that could signal that many areas or metros are at an inflection point. It says that newly built homes are now actually cheaper than existing homes, that according to the latest data. And developers and home builders are now looking at a market that's oversaturated in many parts of the country. That's where you have many more sellers than you do potential home buyers. And looking at new homes for sale, the median price of those homes is down, according to the Census Bureau, to $401,800. That's nearly 5% less than it was just 1 month ago. That's quite shocking. And 2.9% from a year before. It's rare for newly built homes to cost less than existing ones, that according to real estate analyst Nick Gurley, who is the founder and CEO of Reventure app. And he says it's only the 6th time in the last 26 years that this has happened. Nick does have his own YouTube channel, which I find very informative, and I've subscribed to it. You may want to consider doing so yourself. Now, some of these videos look a little bit apocalyptic, and some are. However, Nick tends to be right more times than he's wrong, and I do appreciate that. But his next statement is more important, and it gets to the title of this particular column. He says that the price gap between newly built and existing homes, quote, likely signals an inflection point in the housing market. So this really is an odd turn of events, because typically a new home is going to cost more than an existing home that someone's lived in for decades, right? But here's the rub. It's the homeowners selling their properties who still haven't woke up and smelled the coffee as to what's going on in their local real estate market. And that's why we're seeing more homeowners that have their homes up for sale have that listing sit there for 40, 60, 70, 90 days or longer. And then they play the real estate games of delisting it and relisting it to try to hide the previous price cuts they had to do. It's just a mess. And so as these new home builders have to drop their prices, that's going to apply downward pressure to these existing home sellers. Otherwise, their homes are just going to sit unsold on the market. So this is moving very quickly. It says in the first quarter of this year, the new homes in the U.S. cost on average about $14,000 plus more than an existing home. But now we've seen that flip around. In fact, according to the National Association of Home Builders, now new home prices have actually been falling steadily year over year, even longer in some areas of the nation. Now, of course, not every market, the ones that you're working in perhaps, are going to have new homes that cost less than an existing one, but those areas where home builders really cranked out some serious volume and inventory, those are the areas of the country, such as Florida and Texas, that are seeing these home builders and developers have to really offer some pretty rich incentives to potential buyers to get them to purchase the home. And here's how crazy it's got for home builders. Many of them are now offering very rich discounts, as high as 20% or more. And now they're seeing that their order book of people that are going to be purchasing their homes is actually holding up pretty well, according to Gurley. Overall, new home sales are down only slightly compared to pre-pandemic norms. Wow. But existing home sales are down by over 25%. So you as a reverse mortgage professional, you want to look for those markets in which you're originating where there is a very large inventory of new homes, because that will in fact apply downward pressure to existing home sales in that area. And that means that the comparables on the appraisal of a future reverse mortgage borrower are likely to be significantly less, again, in those specific metros. Just to drive the point home, Gurley says what's happening here is that builders are adjusting to the realities of the current housing market. And I would add, unlike the existing home seller. They're also giving very generous mortgage rate buydowns. They could be a 5 or 10 year, and some builders are offering a 30-year interest rate buydown. So that helps the homeowner have a little bit more purchasing power. It makes the home, of course, a little bit more affordable. And then you couple that with any reduction in the sales price, and it's no question why people are flocking to new homes if they can even afford one today. Now, Nick is a little kinder than I am when it comes to existing home sellers. He says that most of them are probably ignorant about the realities of our current real estate market. But I also have seen many homeowners who do know what's going on in their local market, and they refuse to embrace reality, or they're just jacking up the price of their home because they have to get out of it. They purchased it at the peak and now they find that they can no longer afford it. Those are going to become distressed home sales where they're going to have to slash their prices. And speaking of existing home inventory, it says those that have prices that are pretty close to what we had in the pandemic, they're just sitting there rotting on the vine. They're staying idle on the listings, and those potential home buyers know they can get a better deal, most likely with a new home builder. According to a recent Redfin report, it says that inventory is now at near record levels with 1.9 million active listings, and homes sold in July spent 43 days on average on the market before they went under contract. Now, there is one exception where new home sales will not ding or apply downward pressure to existing home values, and that's where the new home builders have actually reduced the square footage in the attempt to make the home more affordable, so that would not be a true comparable when it comes to an appraisal. In conclusion, you as a reverse mortgage professional, there's no need for panic. Again, as I opened with, not every market in the country is going to see significant price drops, but some will. The key is to be aware of exactly where you're originating your reverse mortgage loans and being prepared for any softening of home prices in that particular area. I believe it's important for reverse mortgage professionals to be aware of the trends in retirement here in the U.S. and what that may mean for older Americans, because that, of course, has a direct impact on reverse mortgage lending, whether it's a needs-based scenario or someone who is looking to have a strategic plan that's going to help them incorporate housing wealth into their retirement plan. So let's dive into the 5 forces that are shaping the retirement landscape across the nation. The first is that we're living longer, but that comes with ongoing expenses that one may be unable to afford. And this first statistic is shocking. It says that in the 20th century alone, the average American lifespan increased by about 30 years, and that has massive financial implications. And the second factor that's shaping retirement is we're beginning to see just the early part of the wave of those who retired with a defined contribution plan. That would be 401ks or profit sharing plans, because they were not the generation that had the defined benefit or pension plans. BlackRock says that is the first generation of retirees who've never had access to traditional pensions. Those born in the 60s, such as myself, well, we're now beginning to retire in force. I believe this is an opportunity for reverse mortgage lenders and professionals like yourself to help those that have retired with a defined contribution plan, such as a 401k, because on average, those plans actually have a much lower balance than one would have in a pension. Now, BlackRock notes there's a third force, and that is the ability to provide lifetime income solutions. So with employers, perhaps they can go beyond the traditional 401k profit sharing plan and also offer their employees the ability to purchase a lifetime income annuity or any other financial product that can give them a source of predictable income. The fourth factor is when people have access to the right tools to prepare for retirement, they have better outcomes. It says that Americans are 15 more times likely to save for retirement if they can do that at work. But here's a sobering fact. 57 million Americans still lack access to a workplace-sponsored retirement plan. And the fifth factor that's shaping retirement that you as a reverse mortgage professional want to be mindful of is that there are big differences in the outcomes for retirement based on race, gender, and socioeconomic status and family structure. Now, BlackRock measures these gaps because they are massive consumers and rely on data that most people will overlook. BlackRock notes that on average, the middle quintile of white American households have about 7 times the retirement savings of those that are Black and 5 times more than households who are Latino. And they see that play out later on in retirement. Their conclusion is that widespread change is needed in the American retirement system, and I would wholeheartedly agree. In the meantime, hey, let's staunch the pain of not having enough money to live on each month, or even better, improve your lifestyle by strategically using housing wealth to leverage your assets instead, and that would be the non-needs-based borrower, we can do all that with a reverse mortgage.